Swayam Prabha. Digital India. Educated India.
Dear participants, in our earlier session, we have discussed about activity based costing. As you would remember, this is a challenge to traditional costing where we identify cost drivers and try to link costs directly to products. Today, we are going to discuss a very important technique known as cost volume profit analysis, also known as break-even point analysis. Sometimes it is known as marginal costing. Before going into exactly what is CVP, I would like you to remind that we had studied types of costs and we had also tried to classify the costs into various types. Do you remember what were the types of costs we had learned? So, one classification is based on elements, wherein we classify the costs into material, labor, expenses. One way of classifying is classification as per direct costs and indirect costs. One way of classifying as per the nature of costs is classifying the costs into fixed costs and variable costs. That is something which is the base of CVP. So, you need to properly know and remember it, then we can proceed for understanding what is cost volume profit analysis. As far as the utility is concerned, the technique is very much useful for taking a variety of decisions. Okay. So, let us now come to classification of costs into fixed and variable. Do you remember how did we define variable cost? Which cost can be considered variable? You can also think of one or two examples of variable costs. So, if you assume that for making 100 units, the cost is 1000 and for making 200 units, if it becomes 2000, then that cost will be called as variable cost. So, it is the cost which changes in the direct proportion to the level of activity or number of units as the case may be. So, if number of units increase 3 times, the variable cost will also increase 3 times. Can you think of some examples of variable cost? Even from your day to day life you can think of such examples. Suppose you are driving a two-wheeler. So, for a two-wheeler, what is a variable cost? Typically, the fuel consumed will be variable. More the distance travelled, more will be the petrol consumed. So, fuel cost is a variable cost. As against this, there is another set of costs known as fixed cost. What is fixed cost? Just think of how will you explain it and also one or two examples of what is fixed cost. Yes, fixed cost is a cost which never changes with the level of activity. It remains constant. So, if you make 100 units and cost is say 1000 rupees, even if you make 200 units, it remains 2000 rupees only. It does not increase. Such type of cost is known as fixed cost. Can you think of any example of fixed cost? Again, come to the example of driving a vehicle. If you are using some vehicle, we have seen that the petrol is a variable cost. What will be the fixed cost? Usually RTO taxes, insurance for the vehicle, these will be fixed. They are a fixed sum to be paid every year and they do not change. Even if you travel for 0 kilometers, even if you travel for 100 kilometers, even if you travel for 200 kilometers, the amount is going to remain the same. This is an example of a fixed cost. Now, on one hand you have a cost which changes in the same proportion known as fixed cost. On the other hand, we have an example of the cost which does not change at all, that is known as fixed cost. In between them, there are number of costs known as semi-variable costs. As the name suggests, they change with the level of activity, but not in the same proportion. So, for 100 units, you have 1000 rupees. If you make 200 units, it won't become 2000, but it will neither remain 1000. So, it is neither variable nor fixed. Maybe it is 1600, 1500, 1300, whatever, but it has increased, but not in the same proportion. Such costs are known as semi-variable costs. Now, give me an example again in the context of use of vehicle. So, while using vehicle, petrol is variable, insurance is fixed, and maintenance could be a good example of semi-variable, because you have to incur some amount of maintenance even if vehicle is idle. As the use will increase, the maintenance cost will increase, but not in the same proportion. So, it is a semi-variable cost. I hope that classification of the three is very clear to you. This is a base for cost, volume, profit analysis. Now, let us try to understand what is CVP, and we will also see the graphs about this cost classifications. Okay. So, this is module 12. We are going to discuss CVP. These are the contents. We will see what is CVP, then discuss about fixed costs, variable costs, semi-variable costs, contribution margin, break-even point, PV ratio. The first part we have already discussed, but again you can see here in the graphical format. Now, CVP is an analysis of three variables, as the name suggests. It analyzes the cost, volume and profit. Such analysis explores the relationship between costs and revenues, and in turn it is bound cost and revenues with the level of activity, and in turn it is bound to impact the profit. Now, we have already discussed this, that one type of costs are fixed costs, which are essentially period costs. They do change not with the level of activity. So, they are completely unaffected with the fluctuations in output, turnover, number of units produced, etc. So, they are called as fixed costs. We have already seen an example in the context of vehicle. Now, there are some more examples. Let us say for a factory, rent of the factory or insurance of the factory building, they will always remain constant. So, in a factory setup, they are good examples of fixed costs. Now, this is a graph of fixed costs. You can see the total costs will rise, the level of activity will also rise from 0 to above, but fixed cost remains that horizontal line which never changes. Is it clear? So, as the number of units increase, the fixed cost does not change at all, it remains completely constant, hence it is known as fixed cost. Now, the other type of cost, which is known as variable cost. Here we have already seen every increase in the level of activity will have same increase in the costs, then it is called as a variable cost. Naturally, when the output decreases, variable cost will decrease in the same proportion. Here the examples more for a production setup are given. So, cost of direct labor, cost of direct material, they are typically variable cost. We have already seen in an example of a vehicle, petrol becomes a variable cost. This is a graph of variable cost. So, it was 0 in the beginning and then it increases linearly. So, every extra unit means there will be some extra cost. This is how variable cost will increase in the same proportion as the output increases. Now, you have semi-variable costs, which are a combination of fixed and variable. So, we have seen that they do change with the level of activity, but not in the same proportion. So, examples are given here like telephone, gas, electricity bills. You know, generally they have a fixed component, and then as you use more, the cost tends to increase. In turn, we can also say that semi-variable costs actually have a fixed component, which is a fixed cost, and we have a variable component which increases. Hence, when we try to do CVP, cost volume profit analysis, we divide semi-variable cost into fixed component and variable component. Fixed component is added to fixed cost, variable component is added to variable cost. So, ultimately we have only two costs. We have fixed cost at one end and variable cost at other end. Now, this is a graph of semi-variable cost. You can see a step-like structure. So, what happens is for 100 to 200 units, it is at certain level. Once the unit costs 300, it suddenly increases, again it becomes constant. It increases again within a level, it remains constant. So, most of the semi-variable costs do increase, but not linearly, they increase gradually and in a step manner. Though it is not necessary that they must increase in step manner, they can also have a sort of curve, not a line, but they can have a curve which is going up, but slightly, say it won't increase in the same proportion as the output increases. Now, let us come to what is the main topic, that is CVP analysis. In CVP analysis, there are three components which are studied. One is the cost, which is divided into fixed and variable cost. The other is a revenue, and the net result is a profit. And as the sale volume changes, the profit changes. Those changes are studied. That is why it is called as cost, volume and profit analysis. Now, this is very, very important and useful for forecasting how change in the volume affects the profitability. We can also use a break-even point tool, hence it is called as a break-even point analysis also. It is useful in the following situations. It is extremely useful for budget planning, because while budgeting, we are never sure as to how many units will be sold or what level of activity will be achieved. That is why one has to make multiple budgets at different level of activity. So, for budget planning, CVP becomes very important. It is also very important for decision making, particularly on pricing and sales volume, because we must know at what volume it is more profitable for us. And you are aware that prices in turn impact the volume. So, if we keep the price high, the volume will be affected. If we keep the price low, the sale volume will increase, but our margins will fall. So, a delicate balance has to be achieved, and those decisions can be taken very well when we use CVP technique. It is also very much useful for determining the sales mix. What happens is, when using the same facilities, we can make product A, B and C, we have to decide which product should be focused, and such decisions can be well taken if we know product wise margin, and we also know the component of fixed and variable cost and the impact of sale prices on the profits. It is very much useful for making flexible budgets, because as we just now discussed, the chances that we achieve different levels of activity exists. So, we have to make budgets at different levels, which is known as flexible budget. Now, objectives of CVP. In cost volume profit analysis, the interaction of these factors is seen. One is a price, then volume or the level of activity, variable cost which is generally measured per unit basis, fixed cost which is measured on total basis because it remains constant, and the mix of products as is proposed to be sold. We should also know that CVP is based on certain assumptions. The first assumption which is used in CVP is that the costs can be divided as fixed and variable. Here we are assuming that all costs can always be identified with this character. It will be either fixed or variable. If it is semi-variable, it will be again subdivided and can be classified as fixed and variable. The second is that there is a linear relationship. So, as the units increase, as the output increase, the sales will also increase, the price will essentially remain the constant. So, in the third assumption we are saying that sale prices and per unit variable costs will be constant, whereas fixed cost will also remain constant at a total level. Of course, this is within a relevant range, say from 100 units to 500 units. We will assume that SP, that is sale price, variable cost per unit is same and fixed cost as a total also remains the same. One more assumption is that volume is the only cost driver. So, there could be some other cost drivers, but we ignore them. Relevant change in the volume, relevant range of volume is also specified, because beyond the range, let us say from 100 to 1000 we have capacity. If the production goes beyond 1000, then we have to obtain a new equipment or we have to increase the capacity, then the cost structure will change. But within the relevant range, the cost structure remains constant. We also ignore the inventory levels because we are focusing on volume and profit relationships. Sale mix is also assumed to remain constant. Of course, it can change and we can take a decision on it, but when we are doing a CVP, we assume that it is constant. Now, let us look at calculations. Certain equations I have given, and these will be useful, and we will also do some cases so that it is more clear to you. All of us know that profit is nothing but sales minus total cost. Now, the total cost itself we divide into fixed and variable. So, we say that profit is nothing but sales minus variable cost minus fixed cost. Now, this sale or the revenue minus variable cost we segregate and we call it contribution margin. So, contribution margin is equal to sale minus variable cost, or we can see total revenue minus total variable cost. Okay? This is a new definition, so keep in mind. Contribution margin, or it is sometimes just called contribution, is sale minus VC. This is how now we make a cost sheet. Normally, we just take sale minus cost to calculate profit. Here we divide the cost into variable and fixed. So, we say sale minus VC, we get contribution. Contribution is a pool which is collected for paying fixed cost, and what remains is a profit. So, from contribution we pay fixed cost, contribution less fixed cost gives us profit. Calculation of contribution is very important when we try to use it for decision making, because as the volume changes, the contribution will change, because sale and variable cost both will change with number of units, whereas fixed cost will remain constant. So, any change in the contribution will have complete impact on profit. Now, the same thing has been put now little more in different format. So, we know that profit is equal to total sale minus variable cost minus fixed cost. Of that, selling price and variable cost are constant. So, we have taken them in one bracket. So, we can say that profit is nothing but S minus V into Q, wherein Q is nothing but the number of units targeted to be produced and sold. Okay. So, sale minus variable cost margin has now been calculated as S minus V into Q minus F, gives us profit. Now, same thing, the same equation can be changed to compute profit, to compute the required level of quantity. That is why we can say that Q is equal to FC plus expected profit upon S minus VC. Okay. So, fixed cost plus expected profit is the amount we want to generate. We generate it by selling the units, which gives us some margin. So, S minus VC becomes a margin for us. So, FC plus expected profit we divide by the margin to know the Q. Now this equation will be very much useful because many times we have to decide what level of activity we should work on or we should target. That is nothing but a Q. Now let us look at a simple example. Now suppose there is a company Superbike, they want to a new mountain bike called as Hero 1 is now been launched. The information is like this: price per bike is rupees 800, variable cost is rupees 300, fixed cost is 55 lakhs, targeted profit is 2 lakhs, estimated sale is 12,000. Now we may be asked, I will just take you back to the information. We know that SP is 800, we know VC is 300, we know FC is 55 lakhs. Now using this data, we can calculate how many bikes need to be sold to generate the target profit of 2 lakhs. Okay. So this is it's calculated. So quantity to be produced, we need 55 lakhs to pay fixed cost plus 2 lakhs of profit plus 55 plus 2 lakh in bracket divided by 800 minus 300. Because by selling one bike, we make a profit of 500. 800 minus 300 is 500 is a margin. So 57 lakh upon 500, we get 11,400 as a target sales. Our estimated sales are 12,000 based on the market search. So we can go in for the production. This is how you can use this information for variety of decision making. Now let us try to understand one more concept, that is known as profit volume ratio, popularly known as PV ratio. Now the contribution margin, it is also known as contribution margin ratio or CMR. So CMR or PVR, whatever you call it, is the percentage by which selling price per unit exceeds the variable cost per unit. We can simply calculate it as contribution upon the selling price. So we take contribution margin as a percentage of revenue. As the name suggests, it is PV. So it is contribution upon sales. Now if we try to do it for Hero, we know that 12,000 is our estimated sales, 800 is a selling price. So 12,000 into 800, the estimated revenue is 96 lakhs. Total variable cost is 300 into 12,000. 300 is a cost per unit, 12,000 number of units. So 36 lakhs. So total estimated contribution margin is 96 minus 36. So 60 lakhs is expected to be the margin. So contribution margin ratio will be 60 lakhs upon 96 lakhs, which is 0.625, or we can say 62.50%. I hope it's clear to you. So the idea is, when I sell goods worth 100 rupees, how much margin is I am earning? So when I sell goods of 100, I am making a margin of 62.5. Higher the margin, naturally higher will be the ultimate profits and lower risk for us. From this margin, the total margin which you can see 60 lakhs, we pay our fixed cost and remaining is our profit. So in the current example, you can see 60 lakhs minus fixed cost of 55 lakhs. So 5 lakhs is our profits. Let us look at one more concept, and once we see that concept, we will go to some cases. This is known as break-even point analysis. In break-even point analysis, we try to calculate the minimum quantity which must be produced to avoid losses, because every company or every entity or any unit do not want to be in loss. So they must know the minimum level which has to be achieved to reach that particular level of to come out of losses, I will say. Below that level you are in loss. Once you reach a level which is no profit, no loss, it's known as break-even point. Above that, you will start making profits. This is again useful for finding a suitable product mix. This is useful for deciding the sales target, to know the profit. I mean, for a particular profit, what should be the sale target, and it also helps us to know the profit at different levels of activity. In break-even point, we use CVP analysis to calculate the BEP. As we have just seen, the BEP is a level of operating activity at which revenues are equal to costs. So, there is a zero profit, or this is a point of no profit or no loss. This is an interesting chart for you. This is known as cost volume profit graph. You can see the red line going from down to up. This is a total sale line. As the units are rising in the horizontal plane, the sales are rising in the linear fashion. The cost to begin with are at 1 lakh, and they are fixed costs, and total cost line is also going up linearly, but it does not start with 0, it starts with 1 lakh. You can see fixed cost line is horizontal. So, fixed costs remain at 1 lakh all the time. Variable costs are going up, so the total costs are also going up. Total costs and fixed costs meet at a particular point. You can see here at 2 lakhs, and in terms of units it is at 400. So, at that point of time, the sale margin takes over the total cost line. Below that, that is for volume of less than 400, you can see the sale line, that is that red line is below the total cost line or total expense line as is given here. So, you have a loss area because sales are less than the cost. At BEP, sales are exactly equal to cost. Above BEP, sales cross the cost. So, you have a profit area. As the sales will increase now, there will be more and more profit. Is it clear to you? Now, this break-even point can be seen graphically, and it is very much useful for making variety of decisions. Here there are some applications of break-even point. It is useful for new product decisions, because before launching any product, company would like to know whether it is likely to be in profit or loss. It is also useful for pricing decisions, because changes in prices in turn changes in have changes on cost, the activity. So, we should know that for what price and at what activity how much will be the profit, so that the proper decision on price can be taken. It is also useful for capital budgeting decisions, like for modernization or for automation, because it will involve some cost, but it will save time, in turn saving the variable cost. It is also useful for expansion decisions. When we want to increase the capacity for the product, then we can increase the level of activity later, but it will entail extra fixed costs for us. So, expansion and modernization, both decisions can be taken using break-even point analysis. Here are the formulas for calculating the BEP. For calculating the BEP in units, take fixed costs and divide it by contribution per unit. We know that contribution per unit is nothing but selling price minus variable cost. So, fixed cost upon contribution per unit gives us BEP in units. For BEP in rupees or in sale value, we take fixed cost upon PV ratio. Are this clear to you? Now, soon we will see some cases wherein it will be very much clear to you how exactly BEP and CV operates. So, you can see here the sale quantity is 5000, selling price is 50, variable cost is 30, fixed costs are 35,000. Using this information, we have to calculate the break-even point. So, first step is compute the contribution per unit, which is 50 minus 30, so 20. So, in other words, when I sell a product for 50 rupees, the variable cost is 30. So after selling every product at 50, I make a margin of 20. Now I have to calculate how many units need to be sold to cover my fixed cost of 35,000. Can you think of? You can even do it orally. So every one product or one unit being sold gives me 20 rupees. I need at least 35,000 to cover my fixed costs. So how many units I have to sell? Could you calculate? Don't look at 5,000, that is the estimated sale. But we want to know the minimum units required to cover up the costs. So you know the formula, it is fixed cost upon contribution. So 35,000 upon 20, you get 1750. Okay. So 1750 units is known as break even point. If you multiply by 50, you get 87,500 rupees, which is a break even sales required, right? There is one more concept related to break even point. Now once the company is operating at a profitable level, they want to know how much safety margin they have. So how much are the actual sales above break even sales, so that they don't go into losses. So margin of safety is actual sales minus break even sales. This is a difference between sales and the BEP sale. Okay. It can also be calculated as a percentage, where we take sales minus BEP, that is margin of safety, divided by sales into 100. Okay. So margin of safety enables the unit or the department to know that due to recession or due to lower sales, in case their sales start falling down, how much it can fall before they land up in losses. Okay. Now in our case, you know that 5,000 was the estimated sale volume. 5,000 minus 1750 is the margin of safety. In terms of percentage, you can say 5,000 minus 1750 upon 5,000. So we get 65%, which means that our current sale of 5,000, even if falls by 65%, we won't land up in losses. So this shows the margin we have with which we can face the recession or fall in volume. Okay. So now we have understood most of the concepts. Let us go for some cases so that we actually see how the concepts can be applied. I will just repeat in short. We have seen the contribution. Can you tell me the formula for calculating contribution? It is sale minus variable cost. Next we have seen PV ratio, profit volume ratio, which is contribution upon sales. Third, we have seen break even point, which is FC upon contribution margin, because we want to know the number of units required to cover fixed costs. So FC upon contribution margin. And last we have seen margin of safety, which is sale minus break even point. So these four formulas are important. Now let us look at cases where we will apply whatever we have discussed to a practical situation. Okay, now let us go to the cases. First one, you can see that the company produced 1000 kgs of product ABC in year 2010, and these are the estimated expenses. Variable cost is 5,000, semi variable expenses 6,000, which has 70% variable component. Fixed costs are 3,000. The total costs are 14,000. Now the production is expected to increase to 12,000. We have to calculate the revised cost for the year 2011. How to go about? In a traditional manner system, we know that the total cost is 14. We will only stick to that and try to say that the cost will increase at some proportion, because you can see that the output is likely to increase by 20% from 1000 to 1200 kgs. So we will say that okay, the cost will increase by 20% or 15%, something like that. But here we have got a breakup of the cost into variable, semi-variable and fixed. Now how will you calculate the cost for 2011? Just think over. Now we have variable costs. Now this cost structure, as you can see here, is for 1000 units. Current level is 1200. It has increased by 20%. So what will be the costs now? What will be the variable cost? We all know that variable cost increases in the same proportion. So into 1200 upon 1000, it will become 6000. In other words, it will also increase by 20%. Semi-variable, we don't know, we can't say it will increase by 20% because it is semi-variable. As far as fixed is concerned, we know that it doesn't change, so it remains at 3000. What shall we do with semi-variable? Let us break it down into fixed and variable. Then our work will be simple. It is given that 70% of it is variable. So how much is a variable component? So the cost of 6000, I will try to break to know its variable component. So it's 6000 into 0.7 because 70% is semi-variable. So it becomes 4200 and remaining 30% is a fixed component. Please try to do it with me. I am just doing it slowly so that you can catch up immediately. Now this fixed component you know is 0.3 and variable component was 0.7 or 70%. So 1800 is the fixed component. Of course, total should not increase. Now we are not taking this into account. This 6000 is divided into 4200 and 1800. So in year 2011, for which we are doing the calculation, see this is 2010, that is last year. We are trying to calculate it for the next year. Now how much will be the variable cost? You know that the total units have increased to 1200 from 1000. So the variable component will also increase to 5040. Fixed component will remain unchanged. So now all the costs are ready with us. We will try to take the total. So there was some problem. So 15,840. Could you all do it? This is the estimated cost. So how much is a percentage increase? If we try to find the percentage change, how much it will be? So you can see the absolute increase is like this. If we try to find the percentage increase for our own clarity, so you can see that variable cost has increased by 20%. This I will just delete. Variable component of SVC will also increase by 20%. Fixed component of SVC will not change. Total fixed cost will not change. Overall, there is an increase by 13.1%. Okay. So this is how we can estimate the costs of next year if we can break down the cost properly into variable and fixed. This is the way also you can calculate the final answer, that variable cost will be now 6, semi variable is 5040, semi variable is 6840 the total, and fixed is 3. So 15,840 will be the revised cost. It's clear? I am going very slow. I hope you can do it as I am discussing. Now let us look at the next case. Now calculate the contribution per unit and the total profitability. We have been given the data about 4 products. I will just push it this side so that you can see it. Number of units are 500, 250, 600 and 400. The selling prices are 50, 40, 90 and 75 respectively. Raw material costs and wages are also given, and we have to calculate the fixed, we are also given fixed expenses 25,000. They are naturally common, not for each product. Now from this we have to calculate the product wise contribution and also the total profitability. So how shall we proceed? Now if you look at this data, you can see that raw material cost and selling price per unit, raw material cost and wage cost are going to change with the level of activity. Fixed costs won't change, they will remain constant and they are common in nature. So first of all, for each product we need to calculate the contribution margin. Let us calculate variable cost per unit, which you know is raw material plus wages, that is 20 plus 10, 30 for product A1, same way for product A2, B1 and B2. Now we have a selling price here and variable costs. You are aware that the contribution margin is nothing but selling price minus variable cost. So it is 50 minus 30, 20 rupees per unit for A1 and 10, 35, 15 respectively for others, that is A2, B1 and B2. Now once you know contribution per unit, we can calculate the total contribution generated by that product. So 20 per unit multiplied by 500, which is the number of units sold. So this is the total contribution. Right, 10,000 for A1, and if we apply the same formulas, it will be 2500, 21,000 and 6,000 for A2, B1 and B2 respectively. Now here we can take a sum. So 39,500 is the total contribution generated by these 4 products. From this we will subtract the fixed cost 25,000. So profit is 14,500. Is it very clear to all? So here for each product we have calculated the profitability by calculating the contribution and then gone into calculating the final profit. This is the way it can be calculated. Now let us take one more. Now here there are 4 products, PUC, QC, RUC and SUC. Again the number of units and other things are given. We have to calculate the contribution per unit and the total profitability. A similar problem. So now we can do it very fast. You know that the first step is we have to calculate variable cost per unit. Which is 23 and 10. Next is we go for contribution per unit. So 50 minus 33, 17 and then so on. Now this will help us to calculate the total contribution. So 9197 from PUC, then 2500 from QC and so on. Now let us take a sum of the contribution generated by all the 4 products, that is 39,427. Fixed costs are also given on per unit basis, but that is not of so much use to us. Actually we need the fixed costs on total basis. So we will calculate the total fixed costs. So 19,980 is the total fixed cost and the profit is 19,447. So you know that profit is contribution minus fixed cost. Is it clear? This is the way also it can be calculated if you calculate fixed cost separately below. Now let us look at the last case for the day, that is on break-even point analysis. We have to calculate now break-even point. There is information about 2 departments, D1 and D2. The direct material and labor costs are given and the fixed expenses are 292,500. The volume currently is 8,000, but they want to know how much will be the point where they should be above profit or loss. So first step you all know now is we must calculate the contribution margin. So for department 1 and 2, the information given currently is on variable cost. So I'll just go down to the solution because we can immediately understand it faster. Selling price you know is 200 as is given here. For D1 and D2, the total direct material cost, that is 25 plus 30 is 55. Labor cost is 40 plus 40, 80. So total variable is 55 and 80, 135. From 200 minus 135 we get contribution. You know now that contribution is sale minus variable cost. Now you are aware that the total fixed costs are 292,500. So to cover up 292,500, how much units are to be sold? So 292,500 upon 65. Fixed cost upon contribution per unit. So the answer is, it is 4,500. Now the same thing can be also converted in rupee terms. So we have 4500 into the selling price, which is 200, it gives us 9 lakhs. Okay. So we'll stop here. We'll see some more cases. In the current session, we have discussed on CVP analysis, PV ratio, break-even point, margin of safety, and we have also seen some cases. In the next session, we'll continue with some more cases on these aspects. Thank you so much.